People get rich in crypto. Prices just surge, fortunes are made overnight, and suddenly everyone starts buying. And then, just as fast, it collapses. Billions of dollars gone. So what on earth just happened, and why does it feel like this keeps happening over and over again? Is crypto just pure unpredictable chaos, or is there a pattern hiding in plain sight? Okay, before we dive in, just a quick disclaimer from us here at Blockspawn's Funds. This explainer is purely for educational and informational purposes. It is not financial or investment advice. All right, let's get into it. All right, so let's get right to the heart of the mystery. You know those huge dramatic booms and busts in crypto? They might feel completely random, but what if they aren't? What if they actually follow a predictable, repeating pattern? What if what looks like chaos is really a cycle? This is really the central question we're going to explore. And honestly, the answer is the key to seeing this market in a completely new light. So if there is a pattern, what does it actually look like? Okay, let's break this down. The key to the whole puzzle is what's called the market cycle. You can think of it like a map that charts the repeating phases of an asset's price, the ups and the downs. And what's driving these phases? Well, it's not really about the tech. It's about something much more fundamental: collective human psychology. So every single crypto cycle, from the absolute bottom to the very top and all the way back down again, moves through these 4 distinct phases. If you can understand each one, you can understand the whole picture. So let's break them down, starting with how a bull market is actually born. You see, the journey to that explosive, headline-grabbing growth, it doesn't start with a bang. It actually starts with a whisper, at a time when almost nobody is paying attention and the market is still full of doubt and skepticism. Now, to really get the cycle, you need to know the 2 main players on the field. On one side, you've got what's called smart money. Think disciplined, institutional players who act very strategically. And on the other side, you have the crowd, who are often driven by emotion and whatever the current trend is. It's the dynamic between these 2 groups that creates these massive swings. So, the cycle begins right here, in what's called the accumulation phase. After a big crash, prices are flat, the news is silent, and the crowd has basically lost interest and moved on. But this is when smart money sees an opportunity. They start buying quietly, accumulating assets at rock-bottom prices, while everyone else is still too scared to touch it. And then, things start to shift. Prices begin a slow, steady climb. You start to see positive headlines pop up. Trading volume picks up. This is the markup phase, the classic bull run. The crowd, seeing prices go up, starts to jump back in, driven by one of the most powerful and contagious emotions in any market. And that emotion, of course, is FOMO, the fear of missing out. It's that feeling, that nagging voice that says you're going to miss the ride to incredible riches. This is the rocket fuel that propels prices to those euphoric, almost vertical highs, when a chart stops looking like a gentle slope and starts looking like a wall. But as we all know, what goes up eventually comes down. And the very same forces of excitement and euphoria that create that incredible rise are also what set the stage for a really dramatic and often painful fall. At the absolute peak of that euphoria, we enter the distribution phase. Now here, prices stop making new highs. They start moving kind of sideways with a lot of volatility. This is where smart money, the ones who bought way back in accumulation, begin to sell their holdings to the crowd, who are still buying like crazy, completely convinced the party will never end. And finally, the markdown begins. The trend breaks. Fear completely replaces greed, and negative headlines are everywhere. The crowd, now facing huge losses, starts to panic sell. This just accelerates the crash, and it ends in total capitulation. That's the point of maximum pain, where everyone who is going to sell, sells. And at the bottom of all that despair, well, the cycle is ready to begin all over again. So what is really driving this incredibly predictable pattern? It's not some fancy algorithm, it's not the technology, and it's not the charts themselves. It's the one thing that never, ever changes. The world changes, technology evolves, but human nature is constant. And that is the key. When you get right down to it, analyzing charts is really about analyzing mass psychology. Because markets are driven by the timeless, powerful, and totally predictable emotions of fear and greed. The legendary investor Howard Marks described it perfectly. He said, "The market's mood is like a pendulum, just constantly swinging from one extreme to the other, from completely irrational optimism and euphoria at the top to totally unjustified pessimism and despondency at the bottom." And this chart, wow, it illustrates the entire cycle so brilliantly. Each of those 4 phases we talked about maps directly onto a predictable wave of human emotion. You go from disbelief at the bottom all the way up to euphoria at the top, which is then followed by anxiety, denial, panic, and finally despondency, which of course sets the stage for a new beginning. It's all right there. Okay, so if human psychology is the engine of the cycle, there are also some unique structural forces inside crypto that act like a kind of clockwork, making sure this pattern keeps repeating itself. And one of the most significant of these forces is the Bitcoin halving. This is an event that's literally hard-coded into Bitcoin's programming. It happens roughly every 4 years, and it directly slashes the creation of new Bitcoin supply. So here's how that works. The halving creates what's known as a supply shock. All of a sudden, the amount of new Bitcoin being created gets cut right in half. Now, if demand for Bitcoin stays the same, or even goes up, this sudden reduction in new supply has historically been an incredibly powerful catalyst, often kicking off the next major markup phase or bull run. So let's just tie this all together. The crucial point here is that crypto's wild swings aren't just random noise. They are part of a predictable cycle that's driven by raw human emotion. It always unfolds in those 4 clear phases. And during this process, wealth has a tendency to move from the reactive crowd to the disciplined, long-term thinkers. And here is what's absolutely fascinating. When you zoom out past all the gut-wrenching volatility of any single cycle, you start to see that these dramatic booms and busts have, at least historically, formed part of a much larger long-term upward trend for the whole asset class. Because once you see this pattern, really see it, you can't unsee it. Now, it doesn't give you a crystal ball to predict the future, not at all. But it does give you a map. It gives you a new framework for understanding the emotional landscape of the market you find yourself in. So the only question left is, for you, what changes now?